Want to know the secret stock picks that will skyrocket your portfolio? I've got you covered with the best investment strategies for maximum profit. Don't forget to like, subscribe, and comment for more videos. Stay to the end for more bonus strategies. The stock market can be intimidating for beginners. It's crucial to understand its function as a platform for buying and selling shares of publicly traded companies. Investing in stocks presents an opportunity to grow your wealth over time. By purchasing shares, you become a part owner of a company, participating in its success. Investing requires careful consideration and a strategic approach. Before venturing into the stock market, it's essential to define your financial goals. Are you aiming for long-term growth or seeking short-term gains? Establishing clear objectives will guide your investment decisions. Remember that investing involves risks, and it's crucial to invest only what you can afford to lose. A well-defined investment plan will help you stay focused and make rational decisions. Start by acquiring a solid understanding of basic investment principles. Educate yourself on different investment vehicles, risk management, and market dynamics. There are numerous resources available, including books, online courses, and financial advisors. Remember, knowledge is your most valuable asset in the stock market. Long-term investment is a strategy focused on holding stocks for extended periods, typically years or even decades. This approach aims to benefit from the long-term growth potential of companies and the power of compounding. By holding stocks for the long haul, investors can ride out short-term market fluctuations and capitalize on the overall upward trajectory of the market. One of the key advantages of long-term investing is its ability to mitigate risk. Stock markets are inherently volatile, with prices fluctuating in the short term. However, over the long term, the overall trend of the market has historically been upward. By holding stocks for extended periods, investors reduce the impact of these short-term fluctuations on their portfolios. Long-term investors often focus on fundamental analysis, which involves evaluating a company's financial health, management team, competitive advantages, and industry trends. They look for companies with strong fundamentals that are well-positioned for sustainable growth over time. This approach requires patience, discipline, and a belief in the power of compounding to generate significant returns over the long run. Diversification is a risk management strategy that involves spreading your investments across different asset classes, sectors, and geographies. The goal is to reduce the impact of any single investment on your overall portfolio. By diversifying, you're essentially not putting all your eggs in one basket. Imagine investing all your money in a single stock. If that stock performs poorly, your entire portfolio suffers. However, if you diversify across multiple stocks, sectors, and asset classes, the poor performance of one investment is likely to be offset by the positive performance of others. There are various ways to diversify your portfolio. You can invest in stocks of companies operating in different industries, such as technology, healthcare, consumer goods, and energy. You can also diversify geographically by investing in both domestic and international markets. Additionally, consider including other asset classes like bonds, real estate, and commodities. Fundamental analysis is a method of evaluating a security by attempting to measure its intrinsic value. Analysts study everything from the overall economy and industry conditions to the financial condition and management of companies. The goal is to determine the worth of a security relative to its price. Investors use fundamental analysis to identify stocks that are undervalued by the market. If a stock's intrinsic value is higher than its current market price, it's considered undervalued and a potential buying opportunity. Conversely, if the intrinsic value is lower than the market price, the stock is considered overvalued. Several key factors are considered in fundamental analysis. These include a company's earnings, revenue growth, profit margins, debt levels, cash flow, and management team. By thoroughly examining these factors, investors can gain a deeper understanding of a company's financial health and its potential for future growth. Technical analysis is a trading discipline employed to evaluate investments and identify trading opportunities by analyzing statistical trends gathered from trading activity, such as price movement and volume. Technical analysts believe that past trading activity and price changes of a security can be valuable indicators of the security's future price movements. Unlike fundamental analysis, which focuses on a company's intrinsic value, technical analysis primarily relies on charts and other technical indicators to identify patterns and trends. Traders use these patterns to make trading decisions, aiming to profit from short-term price fluctuations. Technical analysis utilizes a wide range of tools and techniques, including chart patterns, moving averages, and oscillators. Chart patterns involve identifying recurring formations in price charts that suggest potential future price movements. Moving averages help smooth out price data by creating a constantly updated average price, making it easier to identify trends. Oscillators are indicators that fluctuate between predetermined levels, helping identify overbought or oversold conditions. Risk management is the process of identifying, assessing, and mitigating potential risks to your investments. It's an essential aspect of investing that helps protect your capital and maximize your chances of success in the stock market. By understanding and managing risks effectively, you can make more informed investment decisions and potentially enhance your returns. One of the fundamental principles of risk management is diversification, as discussed earlier. By spreading your investments across different asset classes, sectors, and geographies, you reduce the impact of any single investment on your overall portfolio. This helps mitigate the risk of significant losses due to the poor performance of one or a few holdings. Another crucial aspect of risk management is setting appropriate asset allocation. Asset allocation refers to the proportion of your portfolio allocated to different asset classes, such as stocks, bonds, and cash. The appropriate asset allocation for you depends on your investment goals, risk tolerance, and time horizon. Emotional discipline is a critical factor in successful investing. It involves controlling your emotions and making rational decisions based on your investment plan and market analysis, rather than letting fear or greed dictate your actions. The stock market is driven by a complex interplay of factors, including economic data, company performance, and investor sentiment. These factors can create significant price fluctuations, leading to emotional responses from investors. Fear can cause investors to sell their holdings during market downturns, often at a loss, while greed can lead to impulsive buying decisions at inflated prices. To maintain emotional discipline, it's crucial to have a well-defined investment plan and stick to it. Your plan should outline your investment goals, risk tolerance, time horizon, and asset allocation strategy. Having a plan in place helps you stay focused on your long-term objectives and avoid making rash decisions based on short-term market movements. Continuous learning is essential for success in the ever-evolving world of stock market investing. Markets are dynamic and influenced by a multitude of factors, including economic conditions, geopolitical events, and technological advancements. To navigate this complex landscape effectively, investors must stay informed and adapt to changing market dynamics. One of the most effective ways to enhance your investment knowledge is by reading books, articles, and financial publications. There is a wealth of information available on various investment strategies, market analysis techniques, and economic trends. By staying updated on the latest developments, you can gain valuable insights and make more informed investment decisions. Attending seminars, webinars, and conferences can provide valuable opportunities to learn from experienced investors and financial experts. These events often cover a wide range of topics, from fundamental and technical analysis to risk management and portfolio construction. Engaging with industry professionals can broaden your understanding and provide practical insights that you can apply to your investment strategy. In conclusion, mastering the stock market requires a combination of knowledge, strategy, and discipline. By understanding the principles of long-term investing, diversification, fundamental and technical analysis, risk management, and emotional control, you can navigate the complexities of the market and work towards achieving your financial goals. Remember that investing is a journey, not a sprint, and patience, perseverance, and continuous learning are key to long-term success. As you embark on your investment journey, always prioritize education, seek guidance from reputable sources, and make informed decisions that align with your financial aspirations.
Please don't forget, Like and subscribe for more Money Smart Basics video. Disclaimer: the content provided on this channel is for educational and entertainment purposes only. The information presented is intended to be general in nature and should not be construed as professional financial advice.